Yeah. Yeah, you can start now.
Good afternoon, good evening, and good morning, everyone. This is Joseph Trevisani from Worldwide Markets. I thank you all for attending our webinar today on the commodity recovery. Of course, there should be a question mark after that, since I am going to maintain that as a recovery, it's pretty weak, and as a signifier of what's coming in economic terms, not very reliable. But let us start at the beginning of where we are. There has been a commodity rally. This chart that we're looking at here is the history, the duration of the Bloomberg Commodity Index, which is going to be my basic graph in various forms and in various comparisons for what I'm talking about today. Oh, by the way, we'll do the usual. I thank you all for attending. As I said, again, I thank FX Street and Adinda and Maurizio for putting these on, and of course, Maud, who is behind the scenes, but behind it all. If anyone has any comments, criticisms, or anything else, please type them into the chat, which I am monitoring, and I'll be glad to take off on almost any tangent that you wish for a brief amount of time. I much prefer these to be a give and take rather than a 45-minute lecture on my part. Okay, so from where we started from, if you read the write-up for this, which was posted last week, and they usually post it about a week in advance, it's my contention, as I said, and I'll just read some of it so that everyone, maybe anyone who hasn't looked at the website, although that seems kind of hard to believe since you'd have to be here. But anyway, let's start there. The commodity rally of the last 5 months is less impressive than meets the eye, and I think that's very much true. From the January 20th low, the Bloomberg Commodity Index, the weighted engagement has gained 23% to where we are. This was written about 3 or 4 days ago. But in the context of the chart that we're looking at, particularly this period from here to here, the recovery is minuscule. It hasn't even reached the first Fibonacci level, the 38% level. Most markets that recover reach at least the 68% level. So whether we actually have a real recovery here, as in a reversal trend, or we simply have profit taking on this period here, is the contention we're going to make it now. Now we have the same thing with oil. Let's take a look at oil. The other primary industrial commodity that I use for many proxies for, you can actually use oil almost as a proxy for the whole commodity complex. Okay, where's my WTI chart? Here it is. Okay, this is from 2000 until now. And you can see the parallels somewhat between the Bloomberg Commodity Index and, oops, sorry, I got to open it up. Sorry. Okay, there we go. Between the Bloomberg Commodity Index and WTI. Now, what is interesting about this chart, and this is where we're going to go with this entire presentation. Up until about here, there is a pretty statistically verifiable relationship. I wouldn't say it's quite one-to-one, but it's pretty close. Correlation between these two things. Now, are these driving? No. It's my contention that up until this point right here, what they're doing is they're responding to the same external stimuli. And so you get very similar movements. I mean, here it's identical, here it's identical. Even the peaks and the movements here, look at this. Here, 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 and here. And then through here, right to here. Right to here. What happens in 2011? Fed didn't change interest rate policy. What happened? Well, the Fed started cranking up its quantitative easing programs. And here you get a rather interesting discrepancy. what would be the cause of this particular discrepancy? After all, the economic basis in time, in reality, is the same. Has something changed here for WTI? Or are we simply looking at a variation in levels so that when you present it graphically, it looks as if we have a, how shall we put it, a correlation level that doesn't exist? The difference, to my mind, stems from the different compositions of the two graphs. Now, what do I mean by that? WTI is a relatively well-known, it's very well-known commodity. It is a huge vehicle for speculation. We all know this. This peak back here in WTI was simply lots of position takers driving the market. That remains true throughout this period right here. I think we're seeing a less intense use of the commodity index for the type of speculation that was driving the WTI. Put it another way. This decline in in the Bloomberg Commodity Index is far more fundamentally related, or related far more to fundamentals. You know, I don't have that. Somebody's asking what is the weight of CL in the Bloomberg Commodities Index. You know, I don't have that in front of me. Sorry about that. I know that the commodity, and it's definitely in there, although I'm not 100% sure whether it's both Brent and WTI or just WTI. Most likely it's Brent, perhaps, rather than WTI, simply because WTI is the US standard, but the rest of the world pretty much goes by Brent, which is the European standard. But either way, it is 32 commodities, but I don't know which one. I'm sorry, I don't have the breakdown in front of me. I'm sorry about that. But you're correct. So there's a necessary relationship, and that's a good point, between the commodity index and WTI, since the oil price, since it's a component. It's like when you listen to some of the consumer sentiment indexes, and they include equity levels. They include, say, the Dow or the S&P, and then you're not really getting a measure of consumer sentiment. You're getting a partial measure of the stock market value level, which is driven by, as we know, a few other things than consumer sentiment. Okay. So we're looking at a graph, two graphs that here are starting to diverge in their view of the world. They join up again here. But from this period from here, when quantitative easing is at its height, it affects WTI far more than the commodity index. Now, you can't prove from this chart that the reason WTI stays here and waggles back and forth here while the commodities index declines is because of quantitative easing and liquidity in the system. You can't prove it. But it is the major difference in the world financial system at the time. Certainly, we don't have any large economic growth going through here. We don't have any interest rate policy changes. Okay, so let's put this chart aside. Remember, we haven't quite decided why there are these two this discrepancy through here. We're only observing it. Through back here, at this period here from 2014. Now remember, the Fed decides sometime late in 2013, if I remember, Mr. Bernanke comes out and says, oh, you know, well, we could be ending quantitative easing. Took a while for it to figure out, but suddenly you got this huge plunge. To match up as you have back here through this period here. And here we're now more or less in a similar position. You have, again, the mirror images here, or the reflection images of the two charts. This needs to be accounted for. This is reality, and it matches this reality back here. Okay. So now let us look for some more congruences across. Just take a look at this. This is give you a better sense of the recovery aspects here. This is a 5-year chart of the Bloomberg Commodities Index. Even within that context, from 160, just a little above 160, down to 89, you have a huge decline. You have a very minor recovery. This is certainly not a recovery that predicts or gives you a sense of trend, to my mind. Now, of course, any trend reversal never becomes apparent as that actual turning point until some time has passed and you can see that you've actually done an appreciable move in the opposite direction. But right here we have 6 months approximately, and we're only back to right here. So I'm not looking at this as any sort of signifier as trend reversal. And let's look at the 1 year. Looks a lot better when you do the 1 year. Of course, when you take down the distance that you're covering, it looks much better. Now this, of course, if you're talking from 102 or so down to below 75 and then back up, would give you about a 50% retracement level, which starts to get into the area where you can talk about a trend reversal. Okay, so that's the overall of the Bloomberg Commodities Index. Okay, so what we're looking for, of course, are congruences. We're looking for something that the commodity index. So let's just give one more thing. This is a chart of the commodity index and the Brazilian real. I'm just using the Brazilian real as a commodity reference point for currencies. And again, you see the same sort of, now this is actually a pretty good congruence between commodities and an emerging market country. And then this is exactly what you would expect. As the graphs move, they mirror each other, which is exactly what you would expect. Commodities come down, the real goes down. Commodities go up, the real goes higher. Remember, this is reals per dollar, USD BRL. So as a cause and effect, it's very clearly, and there's so much logic to this one that you don't really have to spend very much time with it, that it's the commodity cycle or the commodity perception or whatever is driving that's driving the real and other emerging resource-based currencies. And this is not simply a matter of the emerging markets. It's true for the dollar Canada, it's true for the Aussie, it's true for the Kiwi. So it is very much a percentage of what the economy is preoccupied with as far as generating its income. So there's nothing unusual about that chart. So let us look for further congruences, okay? So where would we look if we're looking for reasons for the commodity? Remember, let's take a look. This is back to the commodities. Here we go, sorry. When do we start to get this kind of bananas relationship in commodities? This peak mirrors the peak in WTI, which is far more famous. It reflects nothing of economic reality. Let's take a chart that shows us that. This is a commodities index with the emerging markets equity ETF. It's one of many representations of emerging markets funds, stock markets that you can find. What you have from here with all of these commodities goes for WTI, starting about in 2000, you have this enormous interest in trading these items. Remember, these are all trading representations. And what we have a tendency to do when we examine economic logic as to what's driving various instruments, we look first habitually to economics. We all do this. I do it too. Okay, the euro went up today. What happened? The first thing we do is we look for economic cause and effect. But there isn't any economic cause and effect for this peak in 2007 and 2008. Just as in most of the time in trading the euro with the dollar yen, there isn't any direct economic cause and effect. So if it's not an economic cause and effect, if it's not a non-farm payrolls number, or Janet Yellen said, you know what, we're raising rates tomorrow. I don't really care what the markets say. I don't care what the FOMC says. We're going to raise rates, or we're going to lower rates. Not the way the world works. It's, it'd be kind of nice if that's the way it did. At least we'd all have a lot more fun. But it's not the way the world works. These are all responsible, sober individuals. Sorry, but we're not. I'm not going to spend a lot of time dwelling on central bank policy today. But we will have to deal with it, because remember what we're looking for. We are looking for the reasons for the variation in the commodity cycle, why it goes up and down, and how much logic we can tie back to economic activity, meaning as the world economy gets better, the Bloomberg Commodity Index rises, as you would expect. People are using more commodities. Or if the linkage is otherwise, and especially what this decline and this slight recovery might predict. And it will depend on our conclusions a little later about what is actually driving this cycle. To repeat, it is very important that we differentiate, as far as we can, between the factors that are driving these markets. Because we logically, myself included, have a tendency to treat whatever the market movement is as a reflection of an economic reality. And it is my contention that since 2000, but more so since the bubble in 2007, 2008, 2006, 2007, and 2008, and the subsequent crash and the policies around the world since then, that this has gone down as a source of correlation. And that between various commodities, this is why I brought up the WTI chart earlier, I think you're getting a better representation in the commodities index than you are in other items right now. Okay. So remember, we're looking for correlation. What could be causing these things? So let's take a look around. The ones that we've seen now have been reflective. So now we're going to look for causality and see if we can find any. I don't know, maybe there is some, maybe there isn't. Okay, this is US GDP, annualized year-to-year SAR, seasonally adjusted. What is that? SARR. Brain has slipped on it for the moment. Anyway, so this is the Bloomberg Commodity Index. Again, I'm using this to represent the commodity cycle. And the US GDP. Except for this period here. Remember this quarterly annualized returns, the way the US does it. The only people do it that way are the US and Japan. No prize for guessing why. The rest of the world does it differently. They do year on year and quarterlies. Okay, period here. Declining, rising. Well, not the correlation you would expect, so we can discount it. Period here, close correlation. Period here, up to 2011, rising US GDP, some of this base effect, of course, rising commodities. So far, we have a pretty good correlation through here, not a correlation through here, and over here we have the same as that we saw earlier with WTI and the commodities index, a disassociation. Through this period here, the U.S. economy is growing. Since the financial crash, the U.S. economy has grown an average about 2.1% annually. Nothing tremendous. Certainly worrisome for the Fed, but not the kind of, but a steady state growth, ups and downs. What do we see in the commodities index? Goes down appreciably through that period. It would not appear to be the US GDP that speculative traders in the commodities index are looking to for signs as to what's going on. Let's try another chart. I know what the answer is I'm looking for here, but I want to get to it last. Okay. This is something else I should have brought up earlier, so we'll bring it up now. I might as well tell you, the old line is tell them what you're going to tell them, and then tell them what you told them. So I'm going to tell you what I'm going to tell you. It's my contention that the commodities indexes and the WTI and many other trading instruments have become heightened reflections of their own markets because so many more entities are looking for trading results as a replacement for investment results that they can no longer get. Let's take a look at this. This is the Fed funds rate and the commodities index. Let's if I can get another child. Let's just use this one. Okay, so the commodities indexes here. Fed funds. This is Bernanke's bring on the crash. Which remember the Fed saying, the Fed housing, the U.S. Subprime housing, not a problem. It's contained. So you're going to ask a very serious question. Would the Fed have done this, rate hikes, that long progression there, if they had any clue what was coming down the pike? It begs the question, of course, is how could they not have a clue? Remember, these are, in David Halberstam's term, the best and the brightest. That book was about how the best and the brightest in the foreign policy establishment and the government, primarily under Kennedy, but Kennedy and Johnson, got the U.S. into Vietnam. Unfortunately, the parallel is quite similar. The best and the brightest, the government economists, regulators, and bureaucrats, led by the Fed, because the Fed was raising rates, clearly had no clue what was coming down the pike based on the subprime loan crisis. So it's a legitimate question. If the Fed had any inkling about what was coming, would they have done this? My guess is no, but it hardly matters at this point. They obviously did not know what was coming. Remember this when you listen to Fed projections, Fed pronouncements, and Fed analysis. They have gotten it wrong on the US economy and the global economy time and time again. Their biases often seem to rule their analysis. Okay, I said I wasn't going to talk too much about the Fed, but we do have a Fed meeting this week, so it's certainly an apropos moment. Is there anyone out there who thinks the Fed is going to hike this week? Please put a note in the chat, and I'm going to give you an award of some type for your bravery. It doesn't look like, to me right now, the Fed will be hiking in June or July. They're going to have to redeem themselves and their credibility at some point by raising rates before the end of the year, regardless of what happens in the world. But honestly, it doesn't seem like the Fed is terribly concerned about their credibility anyway. Case in point, 3 weeks ago, the Fed governors started jawboning the market. They were all going to raise rates. I mean, 4 or 5 of them, and Yellen are out there saying, June's a great time to raise hikes. The weather's nice. Why not raise hikes? I mean, you might as well cite the weather. If we have good weather in June, we're going to raise rates, or July. I mean, I don't get it. Okay. So what's going on through here? For the period of right here, what happens here? What is this right here? This is the tech crash and then 9/11. This is the tech crash and this is 9/11. And you have the Fed at historically low rates for 1, 2, 3 years. The economy is not doing particularly well through here. US GDP isn't booming. But the Fed kept rates under Greenspan, and I think part of it Bernanke, but he started raising these rates, for 1, 2, 3 years. It's my contention, and for many others, that if you're looking for a cause of the bubbles, and this is a bubble representation, because you are not seeing, at least as far as the US goes, any rise in GDP that warrants this extreme burst of activity in and trading interest and long positions in the commodities indexes. Commodities indexes are historically closely tied to economic growth. This is also the period of the boom and spike in US housing market and WTI. All, especially WTI and the housing market, fueled by availability of credit for speculation, including the commodities index as well. Low interest costs, you see this here. Okay. The interesting change, of course, here is the lack of movement for now how many years? 1, 2, 3, 4, 5, 6, 7, running on 8 years of zero interest rate policy. Not only in the US, around the world. Let's take a look at another chart. Let me show you, I want to make a direct comparison. I'll make one more chart. Okay, let's do the US. Okay, this is 2001 on. US GDP and the commodities index, limited correlation. Okay, we keep this chart in your mind. Wait, yeah, here we go. Okay, this is a chart of, now remember where we're going with this. We have zero interest rate policies, which means many trading venues have to look for profits because they can't find them in their normal avenues. And the purpose of zero rate policies are twofold. Both, in my mind, have failed, but the purpose is, one, to get consumers to spend more so they don't want to keep their money in banks. What have we seen with that? Exactly the opposite. When people can't earn money in the bank, what do? Well, they're saving for their retirement in general. They save more, not less. Why? Because they're not getting any interest returns. So they have a set amount of money in mind. I even heard Arthur Levitt, the former chairman of the SEC, who is very, very good. He was interviewed on the Bloomberg program Surveillance with Tom Keene and Michael McKee. Plug for that program. It's the best, at least in the United States. It is the best economic program. You can learn more on that program than anything else that I know of in the media. It is absolutely brilliant. So unplugged plug for surveillance. It's on in the mornings from 7 to 10 on Bloomberg Radio. It's brilliant. I realize I think you can get it on over the internet too for people around the world. Anyway, Arthur Levitt was saying something which has become painfully obvious, that and apparently the Fed didn't get it, and I really mean this, but the idea that zero interest rates, if you can't keep your money in the bank and earn any money, that you're going to go out and spend it. It's nonsense. Exactly the opposite has happened. People save more because they can't count on getting 3 or 4% and growing it over 20 years in their bank account. They still need the same amount of money when they retire. In fact, they're probably a little more worried now because, after all, why is the central bank keeping interest rates at zero if they're not worried about it? I mean, if everything was fine, why are rates still at zero? And that is going to have a dampening effect on everything, but another topic. So Arthur Levitt was saying that this morning. He is certainly a man of government and a man who believes in governmental institutions. So it's very interesting to hear him say this. He was a very good SEC president. His views on regulation I respect them a great deal. But it's very interesting to hear him say this because he is a man of government. And this is an implicit criticism of Fed policy, that the Fed got it wrong. Okay. The other purpose of zero rates policy is the business side. Well, the business, what are the tripod of spending in economic equations? Well, retail spending, consumer spending, business investment, and government spending. It's usually based on debt, not entirely, but. So those are the three pillars. It's a tripod. So zero rate policy on the retail side, apparently the Fed didn't get it. And what's been the result on the business side? Same thing. Zero rate policy does not end up encouraging people to go out and invest. It's supposed to, because, well, if you're not getting any money out from your account, you might as well go out and blow it. But that's not what happens. It makes businesses far more cautious. Why? Because they can't judge how much money costs. So how do you judge the future profitability of an investment that you're supposedly investing in because you don't want to keep your money in the bank if you can't judge interest costs? What's the scale of costs for a business? Well, first is usually First is usually personnel, and second is usually interest. So businesses are actually inhibited because they don't want to invest. What do businesses have been doing? One of the things that have been propping up the stock market for 8 years now. Share buybacks. And why are businesses choosing to make share buybacks rather than investments? Because they don't trust the market environment. They don't trust the business environment. So both sides of the hoped for results from zero rate interest policy, and this leads back to the commodity index, has been a failure. Okay. So where have businesses invested? Well, we do know a few things that have been successful. First one's WTI. High oil prices first propped up here. It looks the same as this. And then through the period right here when I showed you what was going on. Huge U.S. investment in shale. Two reasons. One, financing was really low. Two, the idea of endless demand from the emerging world, but primarily from where? China. Okay, let's keep this graph in mind right here. This is the commodity index in white, US GDP, Chinese GDP. Now there's a scale effect on here because the Chinese GDP and the US GDP are on the same scale here. Watch what happens when we take out US GDP. Here we go. Remember, this is the commodity index against Chinese GDP. So this, in my mind, is the cause and effect of what's going on with the commodity markets. It's why the recovery is not a recovery. It's why the recovery is nothing more than profit taking. You can discount this period right here because this peak right here is, of course, a reflection of this on a base effect. But from here down, we go from over 10% in China in 2011 to 6.7. What's also true about China, that most of the economic statistics, and certainly GDP statistics, are what called goal seeking. I know Zero Hedge, which is an interesting website, likes to use this term a lot because of the nature of the Chinese system and the way statistics are amassed. If the Chinese central government says they need 6.7 or 6.8 GDP, that's what they expect, that's what they get. So it's a problem. It's very likely that Chinese GDP is substantially less than this. But as far as perceptions goes, it doesn't matter as long as the change, I mean, it does matter, but the change is what we're looking at here. So what effect do we have on the global trading markets of this change? So where are the markets looking for their trading signals? They are looking here. They are looking to the differential effect from China. Something I alluded to a minute ago. Let's dwell on a little bit more. What has been the other result in the West of low interest rates? It's been a lot of malinvestment, but not a tremendous amount. The primary, in the West, the primary, it seems like there are two major effects. One has been the boom in shale oil. Hugely credit funded, 100%. So the trading levels of oil prolonged over around 100 barrels for 4 years when there was zero economic reason for that prompted the development of shale oil and increasing technology and price coming lower because the technology improves exponentially over time and very quickly. So that's, and you get share buybacks in the US. So those are kind of the primary effects, economic effects of low interest rate policy in the US. The shale oil success is one of the things that drove, and the US became started producing back about 2 years ago more oil than it ever produced before. Astonishing, absolutely astonishing. The cries of peak oil, we're running out of oil from the 70s on, are a bunch of nonsense. They're simply not true. You can make other arguments if you want against fossil fuels, and I will not go there. But it's certainly not true that the world's running out of oil. It's not even remotely true. It's not factual. As a position, it's nonsensical, not fact-based. Okay. So in the West, you have share buybacks and you have shale oil. In Canada too, not just the US, wherever it is they invest. What do you have in China? Remember, the Chinese economy, and back in January, the China, by the way, if anybody's paying attention, and it tends not to get much press these days, the yuan is going lower and lower and lower. Look at we want to know, if you want a signpost of the potential problems in the world economy, look at the Chinese yuan, the onshore yuan traded in Shanghai, and see where the government is fixing it. There is no better measure of what's going on in the Chinese economy than the yuan. So just use that as a guidepost. It's the one thing that the Chinese can't goal seek as they will. They need that level to promote export growth, or at least export sales. So back in January, the Chinese created the largest amount of internal loans to fund the economy. Well, what is happening with those loans? The world economy is crawling along. Those loans in China go to build things, but not just things, plants to keep people and existing plants in production to keep people employed. If anybody's been listening to the news, the US over the past several weeks, or past 2 months maybe, the US has put on various tariffs on steel. Why? Because China has built an enormous number of steel plants, cement plants, far beyond, forget about domestic capacity, global demand, way beyond. So the other result of low interest rate policies, and the Chinese are simply doing it differently, but the policy intent is the same. Because what do these loans do? They just flood the market with liquidity, which then is supposed to be used for some purpose. The Chinese direct it. The US hopes, and the West hopes, the markets will pick up on it. Well, they do, but not in the way that these central planners wanted. The Chinese system creates factories, mines, plants that operate in the real world, but in order to keep the people running, the plants running, you have to do two things. Either you continue to provide financing, or you cut the price of what you're producing and flood the world. At least try to sell the stuff. And that's what's going on. But what's reflected in the commodity index, not the equities, the commodity index, is the use and potential use of resources. The idea, and there are a lot of people out there, well, not a lot, but quite a few, well, a fair amount, I'll keep downgrading the number, who are not actual promoters of things, but have been saying that China cannot sustain this because there's nobody to buy the products. And there is no one to buy Chinese products because the world is not growing at the rate that China is building factories and plants and mines and everything else. But the availability of credit, both in the West and in China, remember they're images of the same thing, just done differently. Has finally gotten the attention of, if you personify it, the Bloomberg Commodities Index. There isn't the demand for these raw materials. There's no way to create the demand through artificial support of various markets. So we're looking at again, let's go take a really long-term view of the commodities index. This is the 1991, which I guess is 25 years now, of the commodities index. From 91 to here, you have 120 down to 75. Tied largely to economic cycles, as you would expect. And as credit becomes available in the US economy after 2000, what happens? Volatility and a spike in trading entities, trading instruments through here. The commodities index on a level only reflects, here reflects the much greater intensity of the trading environment, not of the economic growth environment. Some of this is perception, meaning perception that China, certainly after the 2008 crash, the very constant refrain in analysts' depiction of what's going on in the world is China, China, China. Chinese growth. China will manage to do things that no one else has. Economic, historical things. Who was it? One of the New York Times columnists practically praising the Chinese system because it can get things done. The Chinese economic planners are no better than the Fed. Their ability to run the markets and to gain the results that they want are interdependent on what the world does, on the business cycles in the world. Even China cannot forever spend to keep growth going. It is a terminal project, meaning as a project, it will have a termination. All the central banks around the world have been doing the same exact thing, including China. They have been attempting to prolong the cycle until growth on its own reasserts. The problem that they are all finding is that the policies, when prolonged, zero rate in the West, endless spending, government spending in China, over the long period of time, produce exactly the opposite effect. They do not promote growth, they damage it. Chinese investment in steel plants does not create demand. It creates artificial supply, which lowers prices. It's the source of much of the deflationary pressures in the world. Overinvestment, malinvestment, overbuilt industrial sectors. Because the normal decisions, the economic, the profitability decisions that go into whether or not you build a new cement plant, whether or not you drill that shale well, are no longer reliable. And so you get a product and a world that is damaged by these policies. I mean, the Fed, I think, is coming to realize this. The commodities index is coming to realize this, as if there's a commodities index someplace. No one can turn around and tell me how these policies are going to create growth. There is no logical way to get from here to there. Because the policies are the result of government. Well-meaning, I'm not going to argue. But government doesn't create growth. Certainly not in the West. And in China, the growth created by it is unsustainable because it has no economic basis. This is what the commodities are telling us. This is what the commodities index is telling us. Let's take a look at another chart here. Okay, this is sort of the point of all of this discussion. And look at the congruence of these three charts. The commodities index in white, Fed funds in red, and China in purple. Why? You know, you have the Fed funds here, supposedly keeping the world in one piece. You have great variation in commodities indexes through this period here, 2008 to 1. If the purpose of zero rate policy is to promote growth, and the commodities index is a reflection of growth, what can we conclude from this chart? At least as far as Fed policy goes. It is a failure. Does anyone see growth created by zero interest rate policy? The answer is clearly no. What else can we see from this chart? That if the purpose of Western economic financial interest rate policy and Chinese fiscal policy through this period is to create growth, what's the next conclusion we can come to? It also has failed. If we use the commodities index as a increasingly through this period accurate depiction, I think here everyone had the expectation that these policies will work, that China's spending, that through some magic application of Maoist Leninist thought, I guess. Marxist Lenin, what would be Marxist Leninist Maoist thought, the Chinese would be able to create a endlessly expansionary capitalist economy. I mean, the amount of mental leaps required to even say that, let alone expect that it will be true, is very impressive. You must admit that. But both engines here, represented by the Fed funds rate and the Chinese GDP, and reflected in the commodities index, have not worked. I mean, the chart's there. So the conclusion that we're forced to draw is twofold. One, as I said at the beginning, and we're about to end here, so if anybody has any comments, please let me know. I will put in my email address so we can, if anyone has anything they'd like to add, they can do it in private. So the conclusion we're forced to come to, not based on hope, but based on what we're looking at, is that the question that I asked in the beginning, is this commodity rally of this year, granted where we are right in the middle of it, so we don't have foresight and we don't really have any hindsight from someplace in the future we can say that was the turn, just judging where we are now. Does the commodity price level where we are now, and the recovery is basically since the low in February really, mean that we have returned a corner, that we have assumed the rebound we all expect at some point is coming, and no doubt is? My answer is no, we have not. Because the reflection that the commodity index has, you know, in any type of move like this, you can have a whole lot of shorts. Many of them, this improvement down here is a combination of two things. One, belief, and two, short positions. So the commodities index, along with WTI and many other things, to my mind, reflect a market perception, some degree of hope, and profit taking. Because the other indicators that would agree with the idea that a commodity corner has turned, that the world economy is about to start growing again at a much improved rate, and that the demand for commodities will rise, is simply not there. The commodity indexes are not predicting recovery at the moment. Okay, folks. I thank you all for attending. I hope it's been informative and interesting, if not positive. I'm sorry, I do have to provide the analysis that I think is correct. I will type in my email address, and anyone who has any comments, please let me know what you're thinking. And we will do another one next week on Monday. And we are also going to do a special webinar with FX Street on the day of the British vote, the 23rd, on whether or not to leave the EU. There is a direct correlation between the stuff that I've spoken about today, the topics, and both the British vote and the American presidential election, some links of which I hope to draw. In case anyone's not paying attention, which I find very unlikely, the polls in Britain have rather astonishingly started trending towards British exit from the European Union. Make no mistake about it, folks. This will be an earthquake, both politically and financially and economically. And it means we will indeed live in interesting times. Okay, thank you very much for attending, folks. Thank you, Addenda, for putting this on. Thank you, FX Street, for providing the facilities. Everyone have a great day. Thank you.